and thank you for joining Asia Shipping's earnings call for the full year 2025. Please take note of the disclaimer. And today we have the management team of Asia Shipping presenting: Dr. Ibrahim Al-Naderi, Chief Executive Officer, Imad Al-Qaderi, Chief Commercial Officer, and Ahmed Al-Shakaili, SVP Finance. We'll begin with a presentation by a management team in respect to our performance for 2025, as well as outlook for the coming year, and there will be an opportunity to ask questions at the end. With that, I will hand over to Dr. Ibrahim to open the presentation.
Thank you very much, Sharon, and a warm welcome to every one of you, ladies and gentlemen, and Ramadan Kareem to all of you as well. So, 2025 on Asia Shipping. So at the time of the IPO, we've actually articulated a focused growth strategy centered around our expansion, disciplined expansion of our fleet, and of course renewal of business and optimization. Throughout the year, we actually have carried out and continued to execute against our strategy successfully, investing in 16 modern ships. And of course, we sold 6 older vessels in line with our plan. And that is basically to renew the fleet as well as expanding it. So, of course, 2025 delivered strong strategic and operational progress. However, as it is a shipping industry, it also brought headwinds associated with the fluctuation in the global shipping cycle. Despite these market conditions, the business has demonstrated its resilience. So we did a good optimization. We had good growth in terms of investment. Our diversified portfolio has also grown up, as by the end of 2025, we could own and manage around 94 ships across all 5 segments. And these are the segments that we've been always active at. There's also, in terms of delivering of our strategy, we did maintain a strong balance sheet. And that, of course, continues to be in terms of optimistic and new loans and refinancing opportunities as well. It helped a lot in our business. There's also one milestone that we have promised our shareholders at the time of the IPO, that we will work on increasing the return to shareholders. And we've done that. With 2024, we had 23 million Oman Riyal as return to shareholders. By end of 2025, we're talking about 61.2 million Oman Riyal. And that basically shows that the management and the company is doing very well. So, of course, saying that, as I said, also the market brought headwind, which is very much part of our day-to-day life in shipping. But that market dynamics also brought opportunities for us. So despite all the geopolitical tensions around the world, the US tariffs, and of course the sanctions, the supply chain disruption, we continued to basically deliver, and we made sure that our business optimization was as maximum as possible. In terms of our EBITDA, you could see that we had also 61% EBITDA margin compared to 59% the year before, for the year before. Our asset utilization also has done very well by having about 97% of our assets being utilized. And of course, because we also do maintenance and dry docking for the remaining 3%, which was budgeted for. And finally, also charter in vessels, also we did that as per operational needs. So, which was against a plan that we have set at the very beginning of the year. Next slide, please. So for that one, I must say, I'm pleased to report that we maintained a robust safety performance throughout the year, reflecting our strong culture of operation discipline and risk management. And that translates in 0 LTIs, it translates in 0 major incidents and 0 ship detention. For a fleet of our size, that is impressive, I would say. In terms of our long-term earning visibility, as you could see that we have also our backlog, revenue backlog has increased. So now we are talking about 850 million Omani riyals, which is around $2.2 billion, and that is gone all the way to the 2030. Previously, we were talking about $1.7 billion. Now we are talking about $2.2 billion, and that also shows that the company is actually doing well in terms of securing long-term contracts. And of course, being a shipping company, we are very much into ESG and sustainability, and we had the reduction of emission as part of our KPIs as a company, and we did achieve our target for last year, for 2025, and that is basically 2% in line with the industry. Of course, as part of our ESG as well and our in-country value, we continue to develop our Omani capabilities, and as of today, we sit about 90% Omanization here in the office, and first, of course, on board ships. And then there's also, we have about 25 or close to 25%, I would say, of our seafarers are Omanis, and they serve on board our ships. And in order also to continue the approach of our in-country value and enhancing it, we did, of course, a lot of our projects and contracts here within the country. So about 5.4 million Omani riyals were invested in local suppliers, and that is basically to boost the local economies and commerce. Last but not least, when it comes to recognition and awards that we had last year, because we've been seen also as one of the best leading companies within the region. So we did get the Best Ship Manager of the Year award for 2025. We had also the local award of the Best Large Company. That was also in 2025. And of course, for us, in terms of empowerment and in terms of quality and making sure we take care of our colleagues. So we also had the Gold Award for Women Empowerment. And this is also a unique award that's been given to a local company. Last but not least, is basically the Platinum Award for Climate Change. And that because we are walking the talk of preserving our environment and making sure that we deliver on our ESG promises. I would say here, stop here, and maybe I'll allow my friend Ahmed to continue, maybe passing it forward into the finance overview.
Thank you, Dr. Ibrahim. If we go to the next slide. Of course, year 2025 was a busy year for us, doing also the IPO as a start, and then a lot of things during the year have been of geopolitical and wars and many issues. Despite that, I think the company managed to navigate through the year with a good performance. There is a slight drop in the revenue, and that's mainly driven, as I mentioned, by the geopolitical and the market issues, specifically at the first 3 quarters. And in addition, we shifted a lot of our also revenue to be more chartered revenue than the voyage, because we saw that at 2025 to be more secure and more resilient. So the revenue dropped from 366 million to 336 million in 2025. However, the TCE revenue dropped only by about 13 million from 313 to 300 million, because we shifted actually a lot of our revenue to be TCE instead of voyage. We managed also to maintain our strong EBITDA, even better than last year. So 61% were achieved as EBITDA margin, driven by 3 main segments: gas, crude, and product. Also, 205 million was as EBITDA achieved during the year. The net profit, which is about 17% profit margin, which consider a very high EBITDA profit margin compared to 11% last year. This is year-on-year increase by 9% as net profit. Of course, this also take care about the impairment happened during the year when we sold our ships, mainly the old gas ships. They were impaired, and as well we have also gain from sale of selling one of our VLCC, as well as reversal of the old impairment. Of course, as important also element, most of our revenue in 2025 came from contracted revenue instead of spot, because the year started really not very strong in a spot market. So we shifted as much as we can in the beginning to capture the market and make sure that the revenue achieved in a good base. So 13% were only working in spot from our fleet. And we also chartered a lot of vessels from the market in addition to our own. So 63% we operated from our own. However, we bring a lot of ships, about 37% from the market to boost, of course, our revenue, as well also ensure profitability is there and satisfy a lot of our clients. Moving to next slide. This is a snapshot about the high-level performance. So net cash from operation. I think the company is very proud to say that we have increased the net cash from operation by 27% to reach 197 million, which show that the company is really generating a lot of cash, and that will be, of course, for the dividends payout as a start, of course, the expansion plan, as well as repayment of debt, and making sure that the balance sheet is also strong. Direct costs has decreased because as I mentioned, we have shifted to TC revenue, so we don't spend much on the bunker and voyage cost compared to last year, and that's the main reason for this drop. The cash capex also we have, as we planned and we promised also during prospectus, mentioned as well by Dr. Ibrahim, we have grown a lot and we acquired many ships. So you will see that there is a good amount paid for as installment for those ships, or acquiring also ships directly. The two VLCCs bought also in 2025 was fully paid by the company. So 185 million, almost 186 million were paid as a cash capex. The net debt, of course, will increase, which is linked again to the expansion plan. So we also bring a new loan, very competitive debt, to fund our expansion plan, as well also to make sure that we are ready for the growth in the company. Of course, net debt to EBITDA increased to 2.7, while we see this still very healthy for a shipping company, and very competitive because we have a strong cash generation, and also we have paid actually a lot of old debt, which was expensive during the year. So we paid that, and we'll explain that in more details in the coming slides. Assets, of course, increased also by from last year to reach 1.224 million, and of course that was mainly financed through liability, and compared to last year it was 1.08. Moving to next slide. This segmental finance slide mainly to show you the focus of our fleet and how we are making money. So the gas, as a start, gas shipping segments, we have 7 vessels on water. 2 are coming in 2026. They have generated 47 million, and most of them were in a TCE revenue. So 45.4 million as also TCE revenue, which making a very good EBITDA of 33.5 million, which is almost 71% EBITDA margin. Of course, the net profit were dropped mainly due to the impairment we have to do because we have sold our 4 LNGs, and that has, of course, below the book price and in our books net book value. Of course, most of the LNG ships were contracted, and only 1% as spot because it was finished the contract, which is we sold also that ship now. The crude shipping, of course, 14 vessels owned on water today, plus another 7 coming in 27 till 29. And we have chartered as well from the market smaller size ships, mainly Suezmax and one Aframax, to also operate on that segment. We have generated a very strong revenue from this segment during this year, 96 million, compared to, and most of our we have chartered and contracted also most of those vessels, so about 89% were contracted, and that's make EBITDA of 68.7 million, again another 71% mainly coming from this segment. The net profit were also very strong in this segment, of course, from operation as well also from the sale of the VLCC and the reversal of partial reversal of some of all impairment in this segment. Product, while it was really tough year for product segment, we still managed to make a profit in this segment because we have contracted a lot of our ships in a long-term contract, and that's really navigate us during difficult time because the market in the product segments dropped a lot in 2025, recovered only at the end of the year and mainly now in 2026. And still we make also good EBITDA margin from this segments, about 78%, but because we leased most of those ships in this segment for a long term. In the dry bulk, again 11 vessels on water and 3, as we announced, are coming in Q1 2026, which is a Newcastlemax. That chartered in vessels, we have from the market 3 vessels, and of course revenue is about 53.7 million, with most of them also again in TCE, so 49 million on TCE as a revenue. EBITDA is 28.6, which is about 51 to 53%. Net profit is 16.5 million only from this segments. Liner, I think it was a good year for our liner fleet because we have changed the strategy during the year to go more to charter some of our ships on the market, making a very high margin on those ships, which turn around the performance of liner shipping. Of course, we remain doing some of also voyage and satisfy some of the routes. We are always visible there, specifically the Red Sea and also India to GCC. So we make about 5 million net profit in this segment, and about 50-50 was the structure on this segment mostly. This particular slide, I think, we just to show you that we have as a Asyad Shipping a very strong cash flow generation, mainly from our operating activities, and we have a very strong balance sheet and cash flow which can fund actually our requirement for the need of paying as a CapEx plan, dividends payout, as well also funding our debt service requirement. So if you notice that we have closed 2023 as 168 million, we are back now to that level after paying a lot of dividends and as well also paying a lot of new CapEx. So we are 164 as a closing cash balance and deposits in 2025. This mainly driven by high cash generated from our operation. So 197 million was generated as a cash, We made strong, also a lot of capex during the year, 186 million. And also we have paid 63.8 million Oman Riyal as a dividends payment compared to 23 million 0.8 last year only as a dividends. Of course, we have also get very good debt from the market to fund our project. So we have received almost 258 million, very competitive rates from the market, and we paid about 198 of the expensive debt, as well as also the installment of the existing loans. So that's really make our debt profile very competitive. So during the year, we have, I think we can move to the next slide, Sharon, just to continue. You can see here we have access to low cost of debt, and the effective rate of interest today is about 4.3% compared to year 2024 it was 8.3%. So really we are today in a very comfortable position in terms of how much interest we are paying to the loans we are having, and we have due to that also we have increased our assets by 14%. So we feel even we are increasing the debt, but those debt are very competitive, and they can generate a lot of value for the shareholders and for the company going forward. Balance sheet strength, of course, is able by itself to fund the growth and also the dividends required for long term. Also, we are planning to move a lot of short-term debt to long-term debt to manage our cash flow. A lot of those vessels we will receive in 2026, they will be in a long-term debt, which will be also very competitive debt, inshallah, for our future plan. Of course, as we mentioned that net debt increase as this year, mainly because of our expansion plan, which was planned actually to be this way. Now I think I will there's still one more slide. The contracted revenue, as explained also by Dr. Ibrahim, we have increased our contracted revenue from when we met last year, 1.7, and we explained that there are a lot of contracts to be fixed and they will be secured. So we can see that now it is improved by almost $500 million. So our contracted revenue today, after starting from 2026, is reaching 2.2 billion, and this is mainly driven from the gas segments by 681 million, and also the dry bulk shipping by 932 million. Of course, the other segment is also doing a lot, but in a shorter term. So the crude and the product, you will see them also continuously adding to the contracted revenue, because they have a fleet that in a shorter period, like 1 to 3 years contract. So they will keep generating a lot of also contracted revenue in the future. For example, in 2026, most of the revenue is mainly coming from the crude segment as a secured revenue. The 532 million is already secured for 2026, and this is mainly coming from the crude as well as dry bulk segment. The gas fleet, as we explained, we have sold 4, and the other 2 will start mid of the year in 2026. So from there you will see the jump again will start in the LNG segments. I will hand over to Ahmad.
Yeah, thank you, Ahmed. So to run through some operational highlights, as of now, we're looking at a fleet of more than 90 ships. We have 80 ships under our operations. We have 14 ships on our order book, out of which 11 will be delivered in 2026 and 3 to be delivered in 2028. Our average fleet size is 7 years old, which is relatively young for a size of this company with 12.4 million deadweight in terms of capacity of number of ships under our operations. In terms of the utilization, we have a high utilization within our fleet, about 97%. And of course, zero spill incidents, zero LTIs, zero ship detentions. So this speaks for itself in terms of the efficiency of running a shipping company. In terms of the revenue days, it's more or less the same between 2025 and 2024. So we see a consistent earnings capacity for ASCO Shipping Company. On the maintenance side, we had 10 ships that have undergone dry docking, the maintenance that is scheduled for ships on a regular interval. In terms of port calls, so we have called more than 900 ports and in more than 60 countries, given the different diversified fleet size that we have. Next slide. So here we look at the fleet in more detail in terms of the movement from year to year. So if we look at ships on the gas side from 2024 to 2025, we can see that the main attribute of this movement is related to us selling 4 LNG ships, which was mentioned earlier by my colleague Ahmed. In terms of the crude side, this is where we see us acquiring 3 ships that will be coming in, 4 ships that are coming in 2025, 3 that we have ordered in 2026, and 1 that we have sold in 2025. On the product side, what we've done is that we've sold a product tanker in 2025. On the dry bulk side, we have ordered 3 new ships, which are contracted for 10 years, which are the Newcastle Maxes, coming and adding good revenue days for us in the dry bulk segment. On the liner side, we have no change in terms of the number of ships from 2024 to 2025. So just to highlight on the gas side, we have 2 ships that are coming in 2026, which are contracted out on a long term. We have 4 VLCCs coming, 2 of which are contracted for a short-term contract. On the product side, we have 2 ships coming, 1 contracted and 1 still not contracted yet. On the dry bulk side, we have 3 ships which are contracted out on a long-term basis. Next. To give a in-depth overview from what do the segments actually contribute to, just to highlight on the gas side, what we can say is that we carry about 23% of Oman LNG exports, which is what we have done in 2025. On the crude side, we have long-term, medium to long-term contracts with major oil companies. On the product side, to highlight that we carry 50% of methanol out of Salalah, and we do 100% of domestic petroleum products on the coastal side of Oman. On the dry bulk side, we have managed to get 4 years of continuous contracts from our colleagues in Saudi of transporting phosphate, which is an ongoing COA, and this contributes nicely to us. On the liner side, we more or less carry 5% of import and exports to the local market. Overall, our business mix is between 24% Omani business and 76% international business. We have a strong customer base of more than 4,500 clients in all of our different segments. And we see this also growing as we increase our fleet and we come to new contracts, be it on the spot or be it on a long-term basis for our different segments. I hand over now to Dr. Ibrahim, who will conclude on the outlook of the business.
Thank you, Ahmad. So maybe just for the sake of time, we'll go quickly on this one. So looking ahead, we are well positioned for future growth. We expect the delivery of 11 additional ships in 2026 and a part of 2027. with a significant portion already contracted. The ASCO Shipping Company growth CapEx guidance has increased from 0.9 to 1 billion Oman Riyal between 2025 to 2029 to 1.4 billion Oman Riyal until the year 2030. Of course, as I said, with almost 0.7 billion Oman Riyal already committed. We will continue to remain agile and focused on pursuing value creative opportunities that enhance our portfolio, support the execution of our strategy, and create long-term value for our shareholders by mainly balancing long-term contracts for cash flow visibility with spot exposure to capture market upside. And of course, this we need to mention that we'll also have a dividend distribution of about 57.8 million Oman Riyal is expected as per the dividend policy and the IPO prospects. I think this is in general basically what we wanted to share with you today, and we take it forward from here.
Thank you very much. Any analysts or investors who would like to ask a question today should raise their hand by clicking the raise hand button in the bar at the bottom of your screen. And please ensure that you unmute your microphone only when you're introduced. And if you no longer wish to ask a question, then you can click the lower hand icon also in the bar at the bottom of the screen. So we will now take our first question from Boris at Oman Investment Bank. Boris, please unmute yourself and ask your question.
Hello, thanks for presentation. It's Boris Snitsyn from Oman Investment Bank. Actually, a really good one. I like the press release and presentations. Please keep it on. Quite helpful. First question from my side is on your upcoming VLCC vessels in 2026. What are the expectations in terms of the market rates, in terms of the contracts which you are going to conclude for these various ships? Should we expect that they would be concluded at the current prevailing market rates, or it's some prior concluded rates? Please clarify. Thanks.
Okay, thank you. So on the crude side, as you know, that the market has spiked in recent months. So on our strategy for 2026, we have 6 ships that will be coming out of charter, and we will be either contracting them on the spot market or having a very high TC at least for a year. So just as an indication, the numbers that we're looking at are quite high, which could vary anything between maybe $80,000 a day all the way to 100,000 plus. So we expect that within 2026 on our crude performance to be quite solid. And we're very optimistic on the market, especially for 2026 up to 2028 in terms of the requirement of crude carriers in the market.
Thanks a lot for this. May I please clarify, for these 6 vessels you're talking about, your current fleet excludes the new deliveries, right?
Out of the 6, we have 2 from the new deliveries that we have contracted, 2 which are not contracted. So 2 from the ones that are coming into our fleet in 2026.
Okay, so including. Thanks for this.
Yeah.
That's pretty clear. My second question is on your increased CapEx guidance. Could you please maybe elaborate a bit more in terms of the factors behind the increase, and whether we should assume that your long-term fleet guidance in terms of fleet growth for until 2030 so far remains intact?
Can you just repeat what is the first part?
The first part of the question is on your increased CapEx guidance. If you could elaborate a bit more, in terms of the drivers for the increase, and whether it's still intact with the fleet growth targets until 2030.
Yes. Yeah, so it's as I said in the last slide, it's basically it's 0.7 billion Oman Riyal as an increase, and that is mainly for 20 until 2030 from the previous numbers, which we said between 0.9 to 1 billion Oman Riyal previously. And basically, this is to also work our business plan and to make sure that we deliver. So yes, our business plan is intact, and we are going ahead with the expansion plan, both to expand the fleet as well as to renew the fleet and to ensure that we maintain a young fleet age. Just maybe one piece of information which is very important for us to mention here, that we managed to bring down our fleet age to just over 7 years of now in general, which is quite young when it comes to shipping fleets.
Okay, thank you very much for the answers.
Thank you.
Thank you, Boris. We'll now take our next question from Shawar at Vision Capital. If you can unmute and ask your question.
For the presentation, it was a brilliant one. I might add. I have a couple of questions, starting with the recent geo on this in this particular region. Now, from Asia's perspective, what would weigh more? Obviously we can expect a spike in prices with the spike in insurance and everything, if this conflict, goes ahead, and we can also expect some of the route closures. What would impact Asyad more? Would Asyad be a net beneficiary of the rise in prices, or would it be a negative impact on a net basis due to route closures?
Yeah. So look, usually what happens is that when you've got routes that are closed, you have more sailing days. So what you have is that you have a positive impact that comes to shipping, like we've witnessed it on the Red Sea. So what it requires is that more ships to be available, and the demand for shipping also increases. So it's a bit ironic that when you have political upheavals going on, it's kind of positive for shipping.
And maybe just to add to that one, our strategy is also we work in a resilient strategy rather than a reactive operation. So we try to find out opportunities from such challenges, I would say. And this is basically how the shipping market works. And the Red Sea tension gave a very good learning for the shipping companies that we learned a lot from it. So we are actually equipped for if something or a challenge that appears in the future, we'll be much more prepared than previously the case with the Red Sea, of course.
Right, thank you. And how does the Strait of Hormuz impact Asyad?
Well, I would say maybe because, of course, there's it's the energy. The impact, of course, this would be a global impact rather than just only isolated for Asyad. We do operate within the North Gulf. Our ships do go there. So I would say the impact will be equal to the other shipping companies and other shipping lines. And for that, we are also putting plans how to utilize our fleet and how to optimize in such case by basically trying to secure contracts outside the Strait of Hormuz and outside the hot areas, just as contingency.
Yeah, so just to add on to that is that we've got a balance in terms of transporting crude from, let's say, the US Gulf and also West Africa to different parts of the world, not just dependent on transporting crude out of the Arabian Gulf.
Perfect. Thank you. Thank you, sir.
Thank you.
Thank you very much. And just as a reminder, if anybody would like to ask a question, just click the raise hand icon in the bar at the bottom of your screen and wait to be introduced. We'll now take our next question from Sandesh at Uber Capital. Please go ahead and unmute yourself.
Hi. Am I audible?
Yes, we can.
Yes.
Yeah, thank you for the presentation. And my first question is like we noticed a slight compression in TCE revenue despite an increase in the fleet size. Could you like break down which segment is seeing the most pressure on utilization or daily rates? Like if you could give an idea on that.
Utilization on TC, which segment?
Of course, as we mentioned, the most segment during the year is crude and product. They were the major two segments, more than 50% of our revenue coming from these two segments. So, and of course, it is in both, mostly in TCE revenue coming from these two segments.
Okay. You previously guided that the delivery of the three Newcastle Max bulkers, which is set to deliver in 1Q26. So is it on track? Also, the 10-year contract on infringement, which is slated to commence on to 2Q26. If you could provide some color on the pricing mechanism over there as well.
Okay, so look, in terms of the delivery of the ships, it's on track. So we're starting the contract at the end of March 2026. We move forward for 10 years with that contract. We have an agreement with our charter or the COA contract holder, which is Valley, and that's agreed on a metric ton basis. So it's the utilization of the ships over time is where we see the benefit of this contract.
Okay. Thank you.
Thanks, Sandesh. We'll now take our next question from Farhad at EFG Hermes. If you'd like to unmute yourself and ask your question.
Hi, Assalamu alaikum. Good morning, everyone. So I just wanted to clarify two things. Firstly, on the VLCC side, the 4 vessels that are on order, do they get delivered in 2026? And did I understand correctly that 6 of the VLCC ships will be operating in the spot market? The rest will be contracted during 2026.
Yes, that's correct.
That's correct. And the 4 VLCC with the new the shipyard, we are in the negotiation. They may all come in 2026, or as per contract today, they are coming 2 in 2026 and 2 in 2027. But we believe they may all come in 2026.
Thank you.
And we will take our next question from Rahul at Kepler Cheuvreux. Rahul, would you like to unmute yourself and ask your question?
Thank you. Hear me now? Yes. Okay. Thanks very much for the presentation. Just on your new CapEx guidance, would be interested to learn more about the thinking behind that. Presumably, you think that good rates are here to stay. I think you touched on that previously. Which parts of the market do you think are most attractive? Secondly, related to this guidance, is there any change in your thoughts on what the gearing ratio will look like in business?
Where we are going from this?
Yeah, I think we are opportunistic as a company. Today, of course, we have a lot of projects on the pipeline. The focus for us mainly in the energy side. So that's where we see a lot of value. Plus, also dry bulk is also a lot of project is promising there. So we evaluate. Of course, we have something in the business plan today where they are directed. We don't want to disclose specifically which segment they are going. However, if they meet our threshold, those projects are very strong to add value to us, then they will be materialized.
Okay, understood. And on gearing, is there any change in your thinking on what a comfortable ratio you should look at?
Gearing, you are saying? The gearing, I think we are in a good position. we are receiving a lot of very competitive, let's say, leverage for the new vessels because they are with the new technology and the price is also good. They are sometimes attached with the contract. So we may go higher in the new vessels. And of course, that cash will be used to reduce the loans already existing for the old fleet, which we try to make them unencumbered. So easy for us to exit when it is required. So that's the plan. We see, and also those loans coming now cheaper than the loans we have in place. So if that's the case, of course, we will leverage more in the new vessels and reduce our leverage on the old and expensive debt as well as also old debt. The gearing as a whole company, we are not exceeding, let's say, 3.5 net debt to EBITDA. So that's our target.
Thank you. That's great.
Thanks, Rahul. We'll now take our next question from Sahid at Uber Capital. If you'd like to unmute yourself and ask your question. Hi, do you still have a question or?
Hi. Hi, Assalamu alaikum. Thank you, dear management, for the presentation. It was very informative. I just have one question about the product shipping. I've seen it's contribute around 30% to the revenue, while the net profit is only close to the break even. How can you see that, and what can you give us due to that?
Product charted in and then margin.
Yeah, I think, of course, as we explained, the product, we have a big fleet in the product segments, and most of them are leased ships from the market. So the market was not really strong in this segment, and accordingly, the margin we are making was not that big. Of course, also those leased, as you know, they're coming below EBITDA. Because they are in the long term, as per IFRS, you have to show it as depreciation and finance cost in the product side. So I think that's the reason. And of course, we still make a good profit because we have also old contracts in a long term, which is still making money. Of course, while the market was dropping, but those contracts are good. And we believe we chartered more ships actually during the year, end of the 2025, and the margin becoming better now. So we believe this will be in a good shape, inshallah, in 2026.
Okay, and how you compare yourself with Bahari? Because when I look at the financial of Bahari, I see the product shipping is double digit in the net profit side for 2025. And how do you see that?
Yeah, so just to give you in terms of Bahrain and Saudi Arabia, their model is a little bit different on the product side. So they have a lot of good captive contracts from companies like SABIC and other Saudi-based companies that are giving them good margins on the owned fleet that they have. From our book, our product book, we're basically chartering in ships and chartering them out and maybe doing some spot voyages here and there. So on that book for 2025, we didn't see much income last year. However, in the previous year, we had very strong performance for the past 3 years up to 2024. And then now what we're doing is that we are adjusting the product book on the chartering side. So we will have an increased number of ships with good margins, which will contribute positively to our financials.
Okay, thank you. Thank you so much.
Thank you. And at this stage, we have one more question from Tahir at Uber Capital, if you'd like to ask your question.
Hi, Assalamu alaikum. Thank you for the detailed press release and the presentation. I just have one quick question. On one of the slides, you have shown the contracted versus spot revenue, right? And for the calculation of that, you have made a basis that the contracted any revenue which is like more than 90 days would be contracted revenue, right? So
Yes,
I just wanted
right.
to I just wanted to inquire if the analyst community over here will get the same percentages on the basis of 180 days and 365 days. So like we have more clarity with respect to the revenue visibility at least for a year or so.
No, I think we just use 90 days as a spot just to have it is a short voyage, and that's easy for us to do the math. And because we have a huge number of transactions and a lot of big fleet, so we have to put based on what we could consider as a spot and what to consider as a charter. Otherwise, we will not be able to give you that information and present it on a specific basis. Of course, we can do 180 and 360. Then it will require some time to do that calculation.
All right, all right.
Okay, thanks, Tahir. And we'll take our last question from Joyce at United Securities. Please go ahead.
Hello, good morning, gentlemen. Thank you for the presentation and congrats on the good set of numbers. I have three questions, and one is on the rate dynamics that you are seeing right now. Could you please provide an update on the rate dynamics for different segments, as well as how do you see the rates moving forward for the remaining part of 2026?
Okay, you want it per segment?
Yes.
Yeah. So look, the thing is that what we see is okay. If we take segment by segment, you see that on the LNG side, they're long-term contracts, and it's worked backwards from what the cost of the ship is, and then the time charter that you have. So that varies from contract to contract as we move forward. In terms of the product side, this is a market dynamic that we look at, things that can vary between, let's say, the low to mid 20s. This is what we see. From the perspective of the crude side, we see a healthy market within the next couple of years at least. And it's something that is in different ranges. So we can look at an average of about maybe 50 or so thousand per day. It depends on the tradability of the ship. On the dry bulk side, again, it's a market that varies from segment to segment and the size of the ships that we have. But just as guidance in terms of ship cost of a TC between 12 to 14,000. So it varies from segment to segment, but overall we see a positive outlook in these segments on the dry bulk and on the crude and on the product in the upcoming years. So we're quite comfortable with the way forward for the company.
All right, thanks. The second one is on your capex program. One of the observations that I had is you were planning to sell your LNG carriers, gas tankers next year instead of 2026. So just wanted to pick your thoughts on how do you see the capex program going forward in 2026. The immediate capex program, yes, you have given us 5-year outlook, but how do you see it in 2026 and 27? How the dynamics are changing?
Okay, I think we don't want to really disclose much on this. However, we are opportunistic, as we said. If things are coming, good opportunities coming to us in a very good shape for the shareholders and for the company growth, we will not shy away from those. We will take it. Of course, there are a lot in the pipeline. We have already executed a lot in 2025 and 2024 because those vessels show they have good potential. It will be adding a lot of value to our capex program as well also the balance sheet. So accordingly, we take decisions, not necessarily in the coming specific year or in a specific segment. It depends how and when the management and the board see that the best deal can be done. Our balance sheet can support that, and it has enough capacity to take it, and accordingly we do that.
And maybe just to add to what Ahmed just said, yes, we understand there's also a limitation within shipyard slots. However, due to our good relationship with different shipyards, we could manage to secure good slots. And a good example of that one is the contract that we signed at the very beginning of this year for ships to be delivered in 28, end of 28, beginning of 29. Whereas the rest of the market is talking now about end of 29, beginning of 2030. So this is basically how we take it from here. If the opportunity arises, then we will make sure that we take advantage of it, and we will start our own process, of course, by contacting the shipyards directly.
Okay. But that will be in the case of new builds. But you will have some interest on trading the ships as well, correct? No, that's the reason why you're selling the ships.
We do have the second hand.
So
if
which
you see
segments would it be?
2025. Sorry.
Yeah, so
again, it is similar. It is similar answer, because, for example, the Newcastle Max we just executed, we saw there is we can attach those vessels to a contract. Then we executed those vessels. The VLCC we have done, and from second hand, the two VLCC we have done in 2025. They were also we take it before the hike in the market, so we were actually on the right time to take those ships. We could actually do similar things also in future when we can read the market. There is a good opportunities. There are something coming to us. We will also execute it. Not necessarily, even if we say to you, for example, we are going LNG second hand in specific year, we can change that, because if we do the analysis and then we could not attach it to a good contract, good market, then we will be agile and put that capex somewhere else.
Okay. See, the next question is on your VLCC segment. Not exactly the VLCC, but the crude shipping. Crude shipping revenue has been lower than last year in crude shipping itself, despite you adding 2 VLCCs to the fleet. So can you please explain what happened there? But at the same time, I recognize the fact that the EBITDA margin has been improved, EBITDA has been improved, but the revenue has been lower despite you adding 2 more ships. So could you please explain what happened in it during last year?
Yes, I think during last year, I will start with the 2 vessels we have added. They came at the end of maybe the Q3. Mostly they started, so they came late actually on our fleet. So they didn't add much during 2025. So they will add more in 2026. The other things, if you recall, the first 3 quarters, almost the first 10 months during 2025, the market was really in a very low level in the crude. It's only shoot up at the end of the year, mainly Q4. And that's where it start increase. We also changed as from gross revenue, because we saw the market is not improving for first 2 quarters. We changed a lot of also our spot vessels to TC, which can give us a better revenue during that to capture the shorting, and that's of course also added some good amount and good performance for the first 3 quarters. The last quarter, of course, the market shoot up. We already fixed on those vessels, so we could not benefit much, let's say, during the year end in 2025. Overall, I think it did well during that market, because geopolitical and impact on the crude was here also a lot in the beginning of 2025 compared to the end of or today.
Sure. Thank you very much.
Thank you. And we have one final follow-up from Boris. Boris, if you'd like to ask your question.
Yes, thank you very much. Follow up basically on your ship sale plans. Sorry if I missed it. In addition to 4 legacy LNG vessels, which you sold basically in 2026, are there any plans to sell any other legacy ships for this year?
One more ship is scheduled to be sold by the end of this year. It's a ship that's been with us since 2003.
You're talking about LNG or VLCC?
LNG.
Okay. So no plans basically for the rest of the fleet, right?
Mainly only one for now.
Okay, that's clear. Thank you so much.
Okay, thank you all for your questions, and thanks to the Asiad Shipping management team for their presentation today. That concludes our event, and you may now disconnect. Thank you very much.